Paying off your house early is the American dream, but it might be the most expensive financial mistake you ever make. You lock hundreds of thousands of dollars inside drywall and roof shingles, thinking you bought safety. Except you didn't. You bought a feeling. And that feeling hides 3 specific math traps we are going to walk through today. I am going to show you exactly how choosing the safe route of killing your mortgage actually leaves you exposed to a massive risk you are not seeing right now. I am Logan. I look at money differently because I notice the math on paper rarely matches the stress in our heads. We do what we are told is responsible. We work hard, we hate debt, and we want to own our lives free and clear. The standard advice is everywhere. You get a mortgage, but you treat it like an emergency. You throw your work bonuses at the principal. You take that extra $500 a month and you send it to the bank. You want to burn the mortgage. It makes sense. Having no mortgage payment feels like the ultimate finish line. It feels safe because a paid-off house means no one can take your home away. If the economy tanks, you have a roof. If you face job anxiety, you know your living expenses are permanently lowered. The peace of mind is incredibly intoxicating, but for that safety to actually protect you, a few things have to be true. You have to believe that your house is the best place to store cash. You have to assume inflation is zero, and you have to assume you will never need access to that money in a hurry. This is where reality quietly breaks the belief. The safety is an illusion based on how banking used to work 30 years ago. Let us look at the math. Say you have a $400,000 mortgage at a 4% interest rate. You have an extra $500 every month. If you send that money to the bank, you're getting a guaranteed 4% return on your money by avoiding the interest. You save about $70,000 over the life of the loan. That sounds amazing, but let's look at the alternative. If you put that same $500 a month into the S&P 500, earning a historical average of 8%, that money grows to over $700,000 in 30 years. The spread between your low interest rate and the market return is the exact price of your financial freedom. You are paying over $600,000 for the feeling of not having a mortgage. Now you might be thinking, Logan, the stock market is not guaranteed. My mortgage rate is. You are right. The market drops. Recessions happen. But here's the reality check. Inflation is also guaranteed. If inflation averages 3%, your 4% debt is actually only costing you 1% in real purchasing power. Inflation eats your debt for you. A $2,000 mortgage payment feels heavy today. In 20 years, because of inflation, that exact same $2,000 payment will feel like buying groceries. When you pay off a low-interest mortgage early, you are interrupting inflation from doing its job. You are bailing the bank out of a bad deal. But throwing your money at the bank creates a much deeper problem than just missing out on market gains. There's a hidden psychological trap about owning your home free and clear that actually makes you work longer than you need to. I'll break down exactly how that trap works in a few minutes. First, we need to talk about what actually happens when life goes wrong. Think about why you want to pay off the house. You want to protect your family. You want to avoid stress. But what happens when you pour all your spare cash into your house? You become house rich and cash poor. Imagine you lose your job. The economy is in a recession. You have no mortgage payment, which is great, but your property taxes are due. Your health insurance premiums just doubled because you're off the company plan. Your car needs a new transmission. You go to the grocery store and groceries are more expensive than ever. You can't pay the cashier with a brick from your chimney. You can't give the mechanic a piece of your driveway. Your wealth is trapped inside the house. You might think you can just get a home equity loan, but banks only lend money to people who don't need it. If you don't have a job, the bank won't give you a loan against your house, no matter how much equity you have. You're sitting on $500,000 of wealth, but you're completely broke. This is the massive risk I mentioned at the beginning. It's called a liquidity trap. By trying to make yourself perfectly safe from debt, you made yourself perfectly vulnerable to life.
You traded liquid options for a piece of paper that says you own the wood and the glass. Now you might be thinking, but what if I pay off the house in 10 years and then I just invest what would have been my mortgage payment? I hear this all the time. It sounds incredibly disciplined. It feels like the best of both worlds. Let's run the numbers on that. You pay $3,000 a month to kill the mortgage in 10 years. You're debt-free. Then, for the next 20 years, you take that entire $3,000 and put it in the stock market. Here's the problem. You lost 10 years of compound interest. Time in the market does the heavy lifting, not the size of your monthly contribution later on. The person who just paid the minimum on their 30-year mortgage and invested their extra $500 from day one will beat you by hundreds of thousands of dollars. Math doesn't care about your delayed gratification. Math cares about time. This brings us back to that hidden psychological trap. When you aggressively pay down your mortgage, you naturally delay building a liquid portfolio. You keep your cash balances low because every spare dollar goes to the bank. Because your bank account looks small, you feel broke. Even though your net worth is growing through home equity, you don't feel wealthy. So you keep working. You endure weekend exhaustion. You stay at the job you hate. You say yes to terrible projects because you feel like you have to. You tie your entire sense of financial security to a physical location that you can't easily spend. By obsessing over the mortgage, you actually extend your working years. You delay your freedom because you're waiting for a zero balance on a loan instead of a high balance in a brokerage account. You're focusing on the wrong side of the balance sheet. There is one specific scenario where paying the house off early actually makes perfect mathematical sense. I will show you exactly what that looks like in just a moment. But for 90% of people, the math is clear. You should carry the cheap debt and buy appreciating assets. Yet people still resist this. They hate the idea of being in debt to a bank for 30 years. They feel like they're paying massive amounts of interest to a greedy corporation. And if you look at an amortization schedule, it's scary. In the first few years, almost all of your payment goes to interest. But you have to reframe what that interest actually is. That interest is the fee you pay to keep your own money liquid. It's the cost of holding on to your cash so you can deploy it somewhere better. When you realize that the S&P 500 pays you more than the bank charges you, the interest becomes a business expense. You're borrowing money at 4% to make 8%. Real estate investors do this all day long. You can do it too. Let's talk about the one scenario where paying the house off early is actually the right move. If you are 2 years away from retirement and you're facing a severe sequence of return risk, killing the mortgage can save you. When you retire, you have to start pulling money out of your investments to live. If the stock market crashes right as you retire, selling your stocks while they're down is devastating. If paying off the house dramatically lowers your monthly living expenses, it means you don't have to sell your stocks at a loss. In that specific window of life, the guaranteed return of debt payoff beats the volatility of the market. But if you are in your 30s or 40s, that scenario doesn't apply to you. You need growth. So what is the actual solution? How do we balance the math of investing with the very real emotional desire to just be done with the bank? It doesn't have to be all or nothing. You don't have to choose between massive debt anxiety and ignoring your future. We start with a lower bar milestone. Take the extra $500 you want to put toward the mortgage and route it to a standard brokerage account. Buy a simple S&P 500 index fund. Just let it sit there. Don't send it to the mortgage company, send it to yourself. Watch what happens over time. That account will start to grow. It will compound. It remains completely liquid. If you face an emergency, if you need to buy family time, or if you just need to step away from work, that money is right there. It's a shield between you and the unpredictable parts of life. Eventually, you'll hit a scaling point. You'll wake up one day, look at your brokerage account, and realize the balance is larger than what you owe on your house. This is called the crossover point. At this exact moment, you are functionally debt-free. You have a choice. You could sell your investments, pay taxes on the gains, write a single massive check, and wipe out the mortgage tomorrow. You have the power to do it. But you probably won't, because looking at a liquid account with $300,000 in it gives you way more peace of mind than a piece of paper from the bank saying you own your house. When you have the cash, the mortgage stops feeling like a trap. It just becomes a cheap bill you pay once a month. You realize you can pay for your health insurance if you quit. You can say no at work because you have liquid options. You are no longer terrified of the debt because you hold the capital. The math of money is incredibly clear, but money itself is deeply emotional. We buy safety wherever we can find it. Just make sure the safety you're buying is real and not just an illusion built into the drywall of your living room. A paid-off house is great, but a funded life is better.
What would you do with your extra cash every month if you did not feel pressured to feed it to your house? Think about that this week. If this helped you look at your money a little differently, hit subscribe and stick around. We will run the numbers again next time.